Warren Buffett turned $42,000 into $150 billion. That's a 3.5 million% return. And he did it without insider trading, without timing the market, and without buying whatever's trending on social media. Here's what's crazy. His method isn't complicated. It's not some secret algorithm. In fact, Buffett openly shares exactly how he picks stocks. But 99% of investors ignore it because it seems too simple. Today I'm breaking down Buffett's 7 rules for picking winning stocks. These aren't theory. They're battle-tested principles that have worked for over 70 years. And they still work in 2026. By the end of this video, you'll know exactly how to evaluate any stock the same way a billionaire does. No finance degree required. Let's dive in. Rule number 1. Only invest in businesses you actually understand. Buffett calls this your circle of competence. In the late 1990s, everyone was making millions on tech stocks. Friends begged Buffett to buy .com companies. He refused. Know why? He didn't understand the business models. People called him old-fashioned, out of touch. Then the tech bubble crashed in 2000 and wiped out trillions. Meanwhile, Buffett's portfolio barely dropped. Here's how you apply this. Before buying any stock, ask yourself, can I explain what this company does to a 10-year-old? Can I predict where it'll be in 5 years? If you can't answer yes to both questions, move on. There are thousands of stocks. You only need a few great ones. Buffett has said his best investment decisions came from his circle. His worst came from wandering outside it. This doesn't mean only buy what you personally use. It means understand the economics. How does it make money? What could disrupt it? If you can't answer these clearly, skip it. Rule number 2. Look for companies with an economic moat. This is Buffett's favorite concept. A moat is a competitive advantage so strong that competitors can't easily steal market share. Think about Coca-Cola. Sure, anyone can make sugar water, but nobody can replicate 140 years of brand power. There are 5 types of moats to look for. Brand strength, network effects, cost advantages, high switching costs, and regulatory protection. Apple has brand strength and high switching costs. Good luck convincing an iPhone. Facebook has network effects. Costco has cost advantages. Their scale lets them negotiate prices nobody else can match. Walmart has the same moat. They're too big to compete against on price. Here's your test. If a competitor had unlimited money, could they steal customers? If yes, there's no moat. Buffett only invests when the answer is no. Rule number 3. Bet on management that acts like owners, not employees. Buffett obsesses over this. He wants CEOs who think long-term, who allocate capital wisely, who are honest in their annual letters, and who own significant shares of their own company. When a CEO owns 1% of the company, they think differently than when they own 0.01%. Skin in the game changes behavior. Look at shareholder letters. Does the CEO admit mistakes? Do they explain decisions clearly? Or is everything vague corporate speak? Buffett's Berkshire letters are famous for brutal honesty. Here's a red flag. If the CEO is constantly on CNBC promoting the stock, run. Great CEOs focus on building the business, not pumping the share price. Another test. How does management allocate profits? Do they reinvest in growth? Pay dividends? Buy back shares? Or waste it on dumb acquisitions to build an empire? Amazon under Jeff Bezos reinvested every dollar into growth for 20 years. Know the events. Shareholders who trusted that vision got rich. That's owner mentality. Rule number 4. Focus on return on equity, not just earnings. This is where most beginners mess up. A company can show growing profits while destroying shareholder value. How? By constantly raising money and diluting your ownership. Return on equity shows profit per dollar invested. Buffett wants companies consistently generating 15% return on equity or higher. That means for every dollar of shareholder money, the company generates 15 cents of profit annually. This matters because high return on equity compounds. If a company reinvests those profits at the same rate, your wealth grows exponentially without you doing anything. Rule number 5. Buy wonderful companies at fair prices, not fair companies at wonderful prices. This is Buffett's evolution. Early in his career, Buffett bought cheap, struggling companies. He called them cigar butts. One puff left, but not worth it. He lost money and time on businesses that never recovered. Then his partner, Charlie Munger, taught him something. It's better to pay a fair price for a great company than a great price for a mediocre one. That insight changed everything. A wonderful company grows in value every year. Even if you overpay slightly, time fixes it. But a mediocre company stays mediocre no matter how cheap you bought it. This is why Buffett happily pays premium prices for Apple, American Express, and Coca-Cola. He knows these businesses will be more valuable in 10 years, guaranteed. Rule number 6. Think in decades, not days. This might be the most important rule. Buffett's favorite holding period is forever. He bought Coca-Cola in 1988. That's 38 years ago. He's never sold a share. That position is now worth over $25 billion. Meanwhile, the average investor holds a stock for less than a year in 2026. They're not investing. They're gambling on price movements. That's the opposite of Buffett's approach. Here's why this works. Stock prices fluctuate wildly short-term based on noise. But over decades, price follows value. If you own a great business, eventually the market recognizes it. Plus, you avoid taxes. Every time you sell, you pay capital gains. Hold for decades, and your money compounds tax-free until you need it. That's a massive advantage. Rule number 7. When others are greedy, be fearful. When others are fearful, be greedy. This is Buffett's market timing philosophy. In March 2020, markets crashed 35% in 3 weeks. Everyone panicked. Buffett deployed over $50 billion buying stocks. Those positions are now worth over $80 billion. This doesn't mean guess market tops and bottoms. It means when great companies go on sale because of temporary fear, back up the truck. That's when fortunes are made. So here's your action plan. Make a list of 10 companies you genuinely understand. Research their moats. Check their return on equity over the past 10 years. Read the CEO's shareholder letters. Then wait. Seriously. Set price alerts for 20% below current levels. When fear strikes and quality companies drop, that's your moment. Buy it and hold for a decade minimum. If you found this valuable, smash that like button and subscribe to Operation Wealthy. We break down wealth building strategies that actually work. No hype, just results. Remember, Warren Buffett didn't get rich by following the crowd or chasing quick gains. He built wealth by thinking differently, acting patiently, and staying disciplined for decades. You can do exactly the same starting today.